This house in Tacoma, Washington is listed at $490,000, and we're going to walk through a real mortgage quote to talk about what it would look like to buy this house if you have $50,000 saved up to buy a house. Now, a lot of people don't realize that there are actually different things that you can put your money towards when you buy a house. There are different ways to use the same amount of cash that actually impact the interest rate that you end up with and how much your monthly payment ends up being. So we're going to talk about two different ways that you could use that cash. And we'll walk through two different quotes to show you what it would look like in each scenario. For each quote, we'll walk through what your monthly payment would look like. We'll walk through how that cash would be distributed, where it would go, that $50,000. And then we'll talk about how much income it would take to qualify for each scenario, because the qualifying income needed will be different in each scenario depending on how you use that $50,000. And then along the way, as we walk through the quote, I'll explain some really important concepts that you need to understand before you come to get a mortgage. They're concepts that if you don't understand, you're going to end up feeling pretty vulnerable when you're talking to a lender and you don't really know what they're talking about, and you're having to put some blind faith in your lender because the mortgage process is very complicated. So whether or not you've bought a house before, most people don't go through the process more than a few times in their life, and it's very complicated, and there are decisions that have a massive impact on what your overall financial situation looks like and your ability to buy a house. And so hopefully walking through these concepts will make it so that when you come to the process, you're able to at least speak the language of the basic terms and at least evaluate your loan officer and work with them. So if you're wondering how legitimate these numbers are going to be that we're going to be looking at, this is a real mortgage quote that we'll be walking through. My name is Landon Buto. I work with a mortgage broker based in Bothell, Washington, Cleveland Street Mortgage. And so this is a real mortgage quote that we're pulling from our system. And these are going to be very reliable numbers. That doesn't mean it's going to be the exact numbers you'll end up with. There will be variation depending on the day and depending on your exact financial profile. So this isn't an advertisement for these exact numbers, but they will be much more reliable than you'll be able to find just with an online calculator. And they will I'll also be able to explain why the numbers are what they are and explain if they are going to be different, how they might be different, which direction, things like that. So hopefully this will give you a reliable sense of which numbers to actually expect and also understand the numbers a little bit as well. So let's go ahead and hop into looking at the actual numbers. All right, so the way we ended up using the cash, we ended up with an 8% down scenario and a 3% down scenario. And remember, we're coming in assuming you have $50,000 to use or around that. And so I'll explain in a second why these were the percentages that we ended up with, but based on the amount of cash we had available, those were the down payments that we were able to put together. And I'll show you where the cash ends up going in a second. Real quick before we get into the numbers, so up top here, I'll show you what the monthly payment is in each scenario. But before we get into the numbers, I want to point out we are using a credit score of 740 to create this quote. That will have an impact on your pricing, on your interest rate, on your mortgage insurance, on various aspects of your pricing. However, it's not, if you are in the 700s, and especially if you're a first-time home buyer, your credit score is not going to be super impact, especially if you're a first-time home buyer. Your credit score is not going to have a massive impact on what your pricing is, particularly at least your interest rate. But it will show up definitely in your mortgage insurance. It will have an impact there. But as long as you're in the 700s, it's not going to be completely different. It won't be drastically different. If you start to get below the 700s, then you'll get to a little bit more noticeable of a difference in your pricing. It does have a real impact, and there is a real benefit of being able to get up to 760, 780, 800. But if you're remotely close to this 740, you don't need to expect the numbers to be drastically different. So let's walk through. I'm going to actually just walk through both of these together, compare one at a time, so that you can have a sense of how we used the cash differently here. So in the 8% down scenario, just right away you can see your monthly payment is $3,713. Whereas over here in the 3% down scenario, your monthly payment is $3,448. So what happened there? We put 8% down and our monthly payment is higher than when we put 3% down. Why does that happen? I'll explain that in a second. First, I want to show you the components of your monthly payment. Back over to the 8% down. Homeowners insurance, we estimated $125 per month. which in our area for this price point of a house is a pretty common number that we see. It's not going to be, it will vary. That is an estimate. It will vary depending on who your insurance provider is and how much coverage you're getting. But that is a pretty good estimate just as a kind of average number for what we see in this area at this price point. Taxes, you can see $369 per month, and that number is actually drawn from the county website. It is the actual number for 2024 on this particular property, so that is the actual number you can expect. That's going to be the same over here in the 3% down scenario because those numbers are not dependent on the loan structure at all. They do go into your mortgage payment. There are some exceptions to that. Occasionally you can figure out a way to pay those separately from your mortgage payment. You can look into that on your own, but typically it won't make sense. You might have to pay extra fees to do that, things like that. So typically they do go into your mortgage payment, but they're not affected by the mortgage. They're just part of the house. So those will be the same in both scenarios. Mortgage insurance in the 8% down scenario is $105 per month, whereas in the 3% down scenario is $143 per month. Now, mortgage insurance is a fee you have to pay if you are putting less than 20% down. It protects the lender against the possibility of your default on the loan. It's nearly universal in any scenarios where they're not using mortgage insurance. They're typically going to be compensating for that. They'll offset that in their pricing somewhere else. So it really is nearly universal. You're going to have a very hard time finding any situation where if you don't put 20% down, if you put less than 20% down, you won't have to pay mortgage insurance. That's going to be very rare, and even if you do find that, they'll probably be compensating that somewhere else in their pricing. So just kind of plan on that, but what you should keep an eye out for is how much mortgage insurance you're paying. The amount of mortgage insurance you're going to have to pay is dependent on just your lender, who the lender is. It's dependent on your down payment percentage. At 8% down, we're going to have higher mortgage insurance. Or sorry, at 3% down, we're going to have higher mortgage insurance than 8% down. At 8% down, we'll have higher mortgage insurance than 15% down. 15% down is a pretty important threshold. If you can make it to that, even if you can't quite put 20% down, if you could make it to 15% down, that will knock your mortgage insurance down significantly. And then another factor that's very impactful on your mortgage insurance is your credit score. So that will definitely have an impact on how much you're paying in mortgage insurance. So that's what we're seeing in the difference in the two scenarios. And then your loan amount, just it's meant to protect the lenders against the possibility of default, and a higher loan would be worse to have defaulted on, more costly than a smaller loan. So the higher your loan amount, the higher your mortgage insurance is going to be as well. And then that leaves the last component of just principal and interest. The 8% down is $3,114. The 3% down is $2,812. Now we pop down here and we can see the obvious reason for that. In the 8% down, your interest rate that we're seeing is 7.375%. Whereas in the 3% down scenario, your interest rate is 5.875%. Now, why is that? Again, it doesn't make sense. If you put more down, you are going to likely have a lower interest rate. Typically, if anything, it will come down. It doesn't necessarily come down, but if anything. So why do we have a lower interest rate over here? The reason for that is the way we are using the $50,000. So we talked about using that $50,000 differently. The reason for that is the way we are using that $50,000. You can see in both scenarios, we are using basically $50,000 in both scenarios. Over here, you have to bring $50,000 all in, and over here, you have to bring $50,000 all in. The difference is, in this scenario, on the left, we are putting $25,500 towards points. Whereas over here, we're taking a credit of $361, nothing towards points. And so what points are a fee you can pay up front in order to buy down the interest rate, in order to get a lower interest rate. You might hear that as buying down the interest rate. Sometimes, so a buy down is technically a different product, a different loan product, but sometimes people talk about it like that. But points are a way to pay up front in order to get a lower interest rate that you lock in over the long term, over the life of the loan, which in this case is 30 years. So over here, we are not taking any points. In fact, we're taking a little bit of a credit. And credit is the flip side of that, where the lender will say, I will let you take a lower interest, I will give you some cash towards your closing costs if you will take a higher interest rate. So it's basically, do you want the money now or do you want the money in the long run? That's kind of the thing you're evaluating with points or credit. And so here with points, we are paying $25,000 and we're doing the minimum down payment. Say, you come in and you only have $50,000. This is the minimum down payment we could do, 3% down. And then we're deciding to put the rest towards points in order to buy down the interest rate and get a lower monthly payment. Now, why would you do that? We will talk about that in 1 second when we get to discuss how much income it would take to qualify. But there are various reasons you might do that. I'm going to hit on one specific reason, which is essentially it might enable you to qualify for the house without changing the amount of cash you have and without changing your, given the limitations on your monthly income. So I'll talk about that in 1 second. But real quick, I want to point out other closing costs here. In both sections, they're about $9,000, $10,000. Other closing costs, when you come to get a loan, you have to bring more cash than just your down payment. You have to pay your down payment, but then you have to pay the costs involved in helping you get the loan and get the house. And so closing costs, there are generally two main components. One of those is just paying all the people and paying for the services involved in helping you get the loan and get the house. Things like getting an inspection, appraisal, paying your loan officer, escrow and title. There are various things that you have to just pay the people who are helping make it happen. But then the other component of closing costs is what's called prepaids, which are costs that you're going to be paying on an ongoing basis as part of your monthly payment. It's things like your taxes and your insurance. You have to pay some prepaid interest. That's another bucket, is prepaids. They're going to be costs you're paying on an ongoing basis. They're just part of your regular mortgage. But in order to get set up ahead of time, you have to get some of those into escrow ahead of time while the lender is still getting you set up and ready to get you on your monthly payment. We're seeing in both of these right about $10,000, which is roughly the number we use to estimate for closing costs in a typical scenario at this price point in our area. It's coming closer to probably $11,000 to $12,000, but at this price point, this loan amount in our area, this is a pretty good estimate, $10,000 to maybe $12,000. If you start to get significantly above that in either purchase price or loan amount, if you're getting closer to $1 million purchase price and $600,000, $700,000, $800,000 loan amount, then you might be closer to $13,000 to even $16,000 in closing costs. It's going to depend on several things, but one of the key determinants is how much is your loan amount and how much is your purchase price. All right, so if you are looking at these two monthly payments, these two scenarios, how do you decide between them? One of the both of them you're paying $50,000 of cash up front, so it's the same cash coming in, and one of them you have $3,448 in a monthly payment, whereas the other one you have $3,713 as a monthly payment. So it seems like, why not take the one where the same cash, lower monthly payment? So there's lots of things to think through there. I'm not going to talk through all of them right now. What I am going to talk through is one specific scenario where you might only be able to qualify for this scenario. You can't qualify for this one. The lender won't approve you for that monthly payment because your income won't cover it, whereas they would cover you for this. So we'll talk about that and talk about how much income it would take to qualify for each of these scenarios. So that would be one reason you would take that, and we'll talk about that right now. But I do want to specify, again, I'm not going to evaluate entirely which one you would choose, but generally, you have to think about where this money is going right here. Yes, it's $50,000 out of your pocket in both scenarios, but in one of them, it's going into the house. That $25,000 is going directly into the house. Whereas the other one, it's going directly towards the lender, and you're not going to get that back in any way whatsoever. It's a cost, it's a fee that you are paying up front, and you're not going to get that back. $25,000. So yes, you'll slowly, incrementally make it back over time because you have a lower interest rate and a lower payment. But typically that takes a long time, and lenders price those points in such a way that it typically favors them. They know how long the average life of a loan is, and they know that typically most people are going to get out of that loan. They're either going to sell the house, they're going to refinance, something like that, before the consumer ends up benefiting. And even if you do slowly start benefiting, it's only at a couple $100 a month after 5 or 10 or 15 years. And at that point, it's hard to justify that investment up front. So it's important to evaluate that. Let's get into what income it would take to qualify here. So the way lenders figure out how much income it would take to qualify for a loan is they look at what's called your debt to income ratio, your DTI. And your debt to income ratio is your total monthly debts divided by your gross monthly income. And they look at this, your total monthly debts divided by your gross monthly income, and it needs to be less than a certain percentage in order to qualify you for that loan. Now, so far, everything I've said is true of both conventional loans, as well as FHA. It's the way that they figure out with VA is pretty significantly different, so that doesn't apply here. But with conventional and FHA, all of this is true. However, the number that they look at, the number that they use is slightly different with FHA, and I'm not going to get into that here. We're just going to use conventional. And so with conventional, your DTI needs to be less than 50% in order to qualify for the loan. Your DTI, again, they look at your total monthly debts, which is this new proposed housing payment you're trying to take on, plus any other monthly debts you have. Credit card debt, student loan debt, car debt, any other monthly debts you have. They add that all together and they divide it by your gross monthly income, which is your income before taxes. And if that number is less than 50%, typically lenders will approve you for a conventional loan. However, this number right here is not always exactly what you think it might be. You might be thinking of this number as, the number that you're using for budgeting, the number that you are planning on receiving this year. But typically, this number needs to meet pretty rigid guidelines in order to be usable in the lender's eyes. So, for example, it will depend on what pay structure you receive. So if you receive salary, this number is typically pretty straightforward to figure out, and lenders will typically use your entire salary. It still has to check a few boxes. They have to see some level of history there, but it's not quite as rigid. It's much more smooth to get salary qualified and usable than other pay structures, such as commission, if you're heavily commissioned, or if you are self-employed, or if you work variable hours. You don't have 40 hours a week guaranteed. You work maybe 20 here, 40 the next, 25 the next. And so it will, if it's any of those pay structures, then there are just very specific guidelines that income has to meet in order to be qualified. And the way that the lenders figure out this number is pretty, it's not super intuitive. So the best way to figure out that number if you're not salaried is to just talk to a lender and have a loan officer talk to you about your income and have a look at maybe some of your pay stubs, and they'll start to get a sense of what this number might be for you and how much house you can qualify for. So if that's the case, then what income would it take to qualify for each of these scenarios? Basically, we're just going to double this. We're going to assume you have no other debts, and so we're just going to double this number. And whatever double this number is the income that you would have to be making in order to qualify for that loan, assuming you have no other debts. If you have other debts, you just add those debts to this number and then double that. So $3,448, in order to qualify for that loan, you have to be making $6,896 and per month. And then in order to qualify for this loan, you'd have to be making at least $4,426 per month. Let's see what those are per year. Okay, so this is, I don't know why I put 4, that is $7,426 per month. And so you'd have to be making $82,752 per year in this scenario to qualify for that monthly payment up here, whereas you'd have to be making $89,112 per year to qualify for this payment up here. Now, again, sometimes I get the comment that this is bad financial advice. You should never take on a monthly payment of $3,700 if you're only making $89,000 per year. I'm not giving financial advice here. This is not budgeting. It's entirely up to you what monthly payment you're willing to take on. I'm just telling you what the lender would allow you to take on. What are the rules that the lender will adhere to in order to figure out what monthly payment they will approve you for. So this is not financial advice in any way on that. And specifically, one scenario where this might come in very relevant is where maybe you are making twice this. Maybe you are making, maybe you're making close to $150,000 per year. Household income. You and your spouse are making $150,000 per year. But the trick is you are making $80,000 per year, and that's all salary. Let's say $85,000 per year. That's all salary. You are $85K salary. And your spouse is more like, okay, what's the difference there now? $65K? $65K. But that's entirely her, let's say that's her business, her self-employed. She's self-employed, that's her business, that's her LLC. And she just started that this year. She just started that, maybe 9 months ago, and you're on track to make $65K. So you're making $150K household income annually. Great. So maybe you're comfortable taking this on. Again, still not financial advice, but maybe you're totally comfortable taking this on. But this would not be usable probably because she just started it 9 months ago, and you're not going to be able to use that. So in the lender's eyes, you're only making $85,000 per year. You love the house, you're comfortable with the monthly payment, but you're no longer able to qualify for this loan. You only have $50,000 saved up. You're not able to qualify for this loan because you're only making $85,000, you're not making $89,000 in the lender's eyes. And so the only way you could qualify for this house with this amount of cash that you have saved up is to put as much as possible towards points to buy down the interest rate so that your monthly payment is now dropped down significantly and you can now qualify for the loan. So that's one area where using points might come in handy, and using that $50,000 differently is important to understand your options. If you want to get a quote on a house that you're looking at right now, or if you want to have someone look at your income and figure out how much house you could qualify for, how much of a loan you could get, we'd be happy to do that. Again, we are based in Bothell, Washington. We do loans in Washington and Idaho, and we love working with new clients. So please do reach out. All of our contact information is in the description below. You can reach out to us there. There's a video there linked on our website where you can see what it's like to work with us, what our process is like. Obviously, choosing your loan officer, choosing your lender is really important, so we want to make sure you know it's a good fit with us before you jump into it. So go ahead and check out all that information. You can check out reviews online with our company, and if it looks like you'll be a good fit for you, please do reach out. We'd love to work with you.